Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, investors. Today, I have the pleasure of interviewing Shauna Wekherlien, a top 1% tax strategist in the U.S., who you may know better as the tax goddess. She has saved her clients over $1.5 billion. Shauna has also been featured by Forbes, Money, CBS, Entrepreneur, CNN, Fox, and today on The Foundry, where leaders are forged daily. And before we dive right into today's exciting topic, which of course is saving you money, I'd like to remind you, my founders out there, that this is an episode which you requested. I ran a poll to see what you wanted to learn more about, and the results are in. The number one thing that you, the listening audience, wanted to hear about was tax strategies. And so, without further ado, welcome to the show, Tax Goddess Shauna.
Aw, thank you so much. I'm so excited to be here, and I'm so thrilled to hear that the audience wants to hear about taxes. It's my passion, so I'm super excited about today.
Well, I don't know why everybody wouldn't want to hear about it, because again, it's about saving money. That's something that excites me. And I know we do have a lot of 6, 7, and 8-figure businesses out there. So I understand that's your sweet spot. Those are the people that you can help. And so glad to bring you to our listening audience. So I want to say that even with a nickname like the Tax Goddess, I think you're still a bit too modest, because as I understand, of 16,000 people who hold a master's in taxation, that there are actually only 15 certified tax planners in the United States.
You got it. Yeah, I think according to Google, it's something like 660,000 CPAs. And as you start going up in the specialty here, right, you're right, 15, and they refuse to tell us who's number 1, but I know I'm in the top 3, so.
All right, well, if you're not already, we'll hope that today's appearance propels you there. But in any event, so yes, you are a CPA, but you're very different than a CPA. So why don't you explain what is a CPA and what is a tax strategist? How do they differ?
Absolutely. So I always like to talk about the financial team, right? So your CPA is on your team, your bookkeeper is on your team, you might have a financial advisor on your team, right? The tax strategist is another leg on the stool. Okay, so your bookkeeper handles your day-to-day transactions, right? They input the stuff, do the reconciliations, pay your bills. That might be you doing your own bookkeeping. Your CPA, their job is to take whatever information is provided by the bookkeeper and, of course, put that on the tax return to file the tax return with the government. So their job is basically to file returns and make sure you don't get thrown into jail. So always a good thing. We love our CPAs for that. We need our CPAs for that. Of course, your financial advisor takes whatever money you have left over, invests it in the market, make sure that you're going to be good for retirement or to meet whatever goals you want. The tax strategist job is basically sitting between the bookkeeper and your CPA. So your bookkeeper handling all those day to day, the tax strategist comes in and looks at your life from the financial advice perspective, from the insurance perspective, from the entity perspective, trust and estate perspective. So all these different viewpoints. And of course, from a tax strategy perspective. So we look at what kinds of things can we tweak inside your file before we hand it over to the tax CPA to actually file the final taxes. And as long as you do whatever we tell you to do before December 31st, our current average for our clients is a little over 6% in taxes. So getting all those strategies implemented before you give it to the CPA is huge.
I'm glad you said before the CPA, because most people don't realize, wow, by the time you hand things over, I mean, what's done is done.
And so if we don't work on it during the year, whatever, you're right. Once December 31st passed, there's about 5 or 6 strategies that you can go backwards on. Some of them are really small, 1,000 here, 1,000 there. Some of them are big. So there's one that I can think of that might be able to get you 50 or 60,000 off your tax bill, but that's 5 or 6 strategies. we look at over 400 at the federal level alone, plus thousands at the state and local level to really maximize the complete tax savings across the board.
Okay, yeah, well, I can tell you my own stories about working with CPAs that don't understand cost segregation or the definition of an accredited investor, but I won't, because this show is about you. Okay, you're the interesting one. But yes, that's right. It's a totally different breed, and really, really cool. So, all right, now you're talking about saving people just like tons and tons of money. So, well, what is your sweet spot? So when you look for a client, if somebody comes to you, who's the sort of person that you can really help?
Absolutely. So perfect sweet spot. You're paying at least $100,000 in tax liability. So that's between, and there's three categories, right? Federal, state, and what most people miss is the self-employment tax, right? That's 15.3%. So between those three categories, if your tax liability is 100,000 or more, definitely a sweet spot, especially in construction and in real estate, right? If your gross revenue is more than $1 million. So if you flipped 2 or 3 homes, you're easily over $1 million in gross, right? There are specific strategies for people in that category, right? And then, to be honest, the third category is people that are nice. I like working with really nice people that want help. Because, for example, maybe you're paying $70,000 in tax, but you've got to pay for kids' colleges. You are worried about putting into your own retirement. Those are things that we can do, and do them pretty easily from that standpoint. So,
Yeah, great stuff. But I understand that there's also a way that you can help people that may not quite fall into that category yet.
yes. Oh, you hit the nail on the head, George. Absolutely. So I am super excited because we have just launched what we call the 6% Life Group, and I'm going to explain that here in a second. But the new book is coming out, 6% Life. Super excited about that. But the purpose of the 6% Life is for smaller business owners, right? Maybe you're paying $50,000 in tax, $20,000 in tax, okay? You still want the strategies of the big boys. So a little bit of background, a little bit of history. I started off as an astrophysicist, right? Completely different world, switched into tax because of a family thing, right? We've got 800 years of business history in my family. So love the numbers, came over to the tax side, started with KPMG, right? Which only helps, it's one of the big 4 accounting firms, only helps the really big guys, Coca-Cola, Pfizer, huge companies, okay? And when I left there, I said, well, listen, this really isn't exactly fair. I mean, these strategies can absolutely be applied to smaller business owners. So at this point, our main practice, our strategic tax coaching program, works with that $100,000 in tax mark. But if you're paying 20 or 30, and that's still too much in taxes, according to your own heart, right? I don't want to pay a penny more than is legally required. The 6% group, the 6% Life coaching group, actually gives all of the strategies, Q&A, brings in panelists, brings in all sorts of resources that you as a small business owner can listen to and implement to reduce your taxes, even if it is just $5,000 or $10,000 a year. For a lot of people, that $5,000 or $10,000 can make the difference, all the difference in the world. So, oh, I lost you, George. I'm so sorry. Darn internet.
So if you're listening, and as opposed to watching us on YouTube, so she just held up the 6% Life. Make sure you go and check that out. It looks like that should be coming out this fall.
Super excited.
I'm excited too. Yes, I love. And you know what else I love? I know you may not know this, but many of my listeners do. So I was an award-winning data scientist before this. So love to interview technical people. I think technical people are awesome. But my favorite sort of technical people are people who also happen to be master communicators, which is pretty rare.
I have been told that when I tell people that I'm a CPA, they're like, no, you're lying. You have way too much charisma for being a CPA.
All right, awesome. Well, anyways, this show, most of our entrepreneurs are focused on real estate. So let's talk about some of the best real estate tax saving strategies that are available right now.
Absolutely. So you named, of course, the cost segregation, which everybody knows. So I'm not going to go into that in detail, but it is my favorite question if you're out interviewing CPAs and you ask about a cost seg and their eyes glaze over, run away, right? As a real estate, you got to go find somebody else. Now, one of the other big ones that a lot of people miss, or I would say misunderstand, is the short-term rental classifications, right? So we get a lot, of course, Airbnb is blown up, right, over the past few years. And we have a lot of tax returns that come in where they meet all of the short-term rental active qualifications. And my favorite part about this, now, the best combination in the tax code, best out of all the things in the entire tax code, is if you have one spouse who has a W-2 or has a very successful business, and the other spouse can qualify as a real estate professional, okay? So understanding that real estate professionals, so 750 hours, more time on real estate than you do on anything else, right? And making sure that you're meeting those qualifications is super important, all right? But on the other side of that, we have a lot of people who are single, right? They haven't found their perfect real estate spouse yet, right? And so they're high wage earning W-2s. They've gotten into real estate because real estate is a great investment for many people, but they're not able to take any of the losses that they're earning on their real estate property because they make too high of a W-2 income, okay? So one of the things that I love is the short-term rental market. So as long as you have 100 hours, more hours than anyone else, and the average term of your rental is less than 7 days, you can now take deductions, you can take losses as active income, which means it can offset your W-2 income, which is huge, right? Typically, there's a limit of about 25,000, but these are these kind of little tweaks and little questions. Often what we find is CPAs just aren't asking the right questions to know whether you should go short-term rental, Airbnb, like which way you should be reporting any specific property that you're particularly working on.
Great. Now, say that again. I think you said you have to have 100 hours more in your short-term rentals. So we're not talking about our real estate professional status where you better not be doing that if you got a W-2. So this is something you could potentially be doing. Yeah.
Yeah.
I don't want to be in front of that audit committee.
Yeah, no. Well, yeah, so this is something completely separate, right? I mean, technically, there's the main three categories of owning a rental property, right? So you have real estate professional, which is the creme de la creme, right? 750 hours, your main job is real estate, you're doing more real estate than you're doing anything else, right? So that's like the creme de la creme, but not everybody qualifies for that, right? The next level is active, and your W-2 is not more than 150,000 a year. So active just means that you're making telephone calls, you're getting the plumber over there, you're checking the AC units, through the AC company is showing up, you're just kind of managing the property, right? You're being active on it. And then you have completely passive, meaning I have a management company, I don't touch it, I sit back and collect a check, okay? So with passive, if there's losses, which of course, using cost seg, using other strategies, the whole point is to get it to tax loss, not actual cash losses, right? We like cash flow, but tax losses, that's the perfect combination. But if you are passive, you can't write any of those losses off. They basically get trapped in a bucket, right? So if you can get to active and you qualify, you can get about $25,000 worth of losses as long as your other income is not over about 150. And then real estate, you can take all the things, right? So if you've got a spouse making a $300,000 W-2 and you have $300,000 in cost segregation losses, the family pays zero, right? So that's why the real estate professional is the creme de la creme of all the things. But
yeah, I love it. Well, I finally did leave my life as an award-winning data scientist. So looking forward to seeing what this real estate professional status can do for me. But of course, you know that being in real estate, if you do things right and if you do plan ahead,
yes.
isn't that the hitch, right? You got to plan
Absolutely.
ahead. You can do very, very well. There's a reason for that too, right? Our government decided that people need a place to live. I mean,
Yes.
it is a necessity.
Yep.
And so there's a reason that our tax code is kind to people who are producing, maintaining, and operating real estate.
I love government incentives and I'll use them all day long and everything we can. I'm 100% in, 100%. So yeah, and then this fourth category that people just it kind of seems to get left off of the books, and I never understood why, because it's super powerful. If you've got one of these Airbnbs and you're providing significant services, so you're picking them up at the airport, you're cleaning while they're there, you're taking them on tours, trips, something like this, right? So you can have one of two categories there. Either the total rental average days is less than 7, in which case you can get that middle, that active status of real estate. So you can get at least 25,000 losses, okay? Or if the average rental days is less than 30, but you're providing all these extra services, tours, hotels, picking them up, food, you know, think more like a bed and breakfast almost, where there's all these extra like personal services, right? You can take, again, all of the losses. It is now a business and not really a rental. So there's some super cool things there. And these are just things that CPAs kind of miss because they're not asking the appropriate questions to really figure out which path you need to take. So. Oh, I lost you again, George. I'm so sorry.
Sorry.
It's just killing us today.
Not asking the right questions, appropriate questions. Wait, my experience with CPAs is, well, they don't ask any questions at all. Right? Yeah,
So,
I mean, isn't that frustrating?
well, and this is one of the things we always tell people, listen, when you start working with somebody who specializes in real estate, when they specialize in strategy, your normal CPA will ask you, you know, here's your organizer, here's the 30 questions for this year, fill out the data, right? People hate me for the level of questions that we ask. Our questionnaire, our organizers over, I think it's about 500 questions at this point. And all the way down to, and so you asked about other deductions, right? Let's see, are you paying private tuition for your child? If your kid's older than 7, we can put the kid on payroll through your business. And now we have a massive deduction up to $19,850 for 2023, completely tax-free. Do you have a dog? If the dog at its shoulder is taller than the height of your knee, and you take the dog with you, so you go to look at some property, you take the dog with you, it is now security, meaning you can write off the dog and the vet and the toys and all the shots and grooming and everything else, right? So there are so many little tweaky things that if you don't ask about, you'll never know that you can do them. So.
That's awesome. So now I have a question. I know you mentioned a lot of Airbnb / short-term rental deductions,
Yeah.
But one that I don't think you mentioned yet, they call it the master's exemption. So does that mean that you have to be awarded one of those green jackets?
Nobody would ever get that deduction if that was true. No, I love it. Yeah, so the master's exemption actually relates to the ability for your business to rent your home from you or renting it out to anyone else. Okay, so it's effectively 14 days of rental income from someone else. And I'm doing that in air quotes for a reason here, from someone else. 14 days of rental income, not more than 14 days. Any income you earn is 100% tax-free, okay? Now, the coolest thing about this, most people think about, well, I don't really want to rent out my home to strangers. You know, we hear all these horror stories about them ripping copper out of the walls and destroying the place and this kind of thing. If you have a separate business from yourself, an S Corp, a partnership, a C Corp, an LLC taxed as a sole prop, there are some caveats there, okay? But if you have a separate business from yourself, your business can rent the house, your house, from you up to 14 days a year for business events, masterminds, networking, meeting with your vendors, your crew, your staff, these kinds of things, okay? Now I'm gonna use the rates here local to where I am, Arizona. The average rate per night in Phoenix is $3,500 per event. That's a $49,000 tax deduction every single year if you do all 14 events, and it's completely tax-free. It's pretty cool.
Yeah, pretty awesome. So I understand though that there is an actual relation to the masters. So can you tell us where did this actually come from?
Yeah, this is one of my favorite bits of this. So the one thing I love about being an American citizen, okay, is that if the government writes a law for themselves, it applies to us too. Okay, and that's exactly where this came from. So yes, the master's exemption, it's sometimes also known as the Augusta rule. And if you're a golfer, you just tied those two together in your mind, okay? The Masters golf tournament is in Augusta, Georgia. So all the senators, congresspeople, wealthy people that had homes in that area, when the Masters tournament came through, they wrote themselves a law that says, we want to rent this out. We don't want to pay tax on it. So 14 days it is, right? And that's exactly what they do. And we get the same thing in cities around the US, right? Again, here in Phoenix, we have massive football games, right? A lot of baseball during spring training, these kinds of things. And so people will rent out their homes either to outside parties or again, to their business, hosting guests, hosting vendors, hosting teammates, that kind of thing, so.
All right, now let's move on to interest rates. I know that we don't need to remind this audience that interest rates have risen dramatically since 2022, but what can you do as an investor to protect yourself from taxation now that these rates are higher? What sort of strategies are now in vogue?
Absolutely. Well, one of the very first things that comes to mind, and it's a little bit of a longer play, one of my favorite strategies, two of them actually, one of them is called infinite banking. Now, this one is not a tax deduction. So I'm going to say that right up front. But what it does is it protects you against interest rate fluctuations. Okay. So an infinite banking program is a way for you to put away a small amount of money each month, $100, $500, $1,000, whatever it is. Any earnings on that money for life is tax-free forever. Okay, so it doesn't matter how much you earn in there, it's completely tax-free. Now, what I love about this, and it's that's why I'm saying it's kind of a little bit of a longer term, once you have a policy base, this is a type of life insurance, once you have a policy base, you can borrow from yourself at whatever the AFR is, the applicable federal rate. So even if the banks right now are at 6, 7, 8, 9, 10, 12, 15, 20, whatever the rates are, the current AFR, the last time I looked at it, was about 3.5%, meaning you can borrow from yourself at 3.5%. It's not taxable, and any interest that you pay is paid back to yourself rather than a bank asking for 9%, whatever it is. Now, one of the things you can do here, because a lot of people are saying, well, Shauna, that's great, but I didn't have one of those. I just learned about it right now, just listening to it. You can actually convert current 401ks, IRAs, SEP IRAs, simple IRAs into this type of program to get access to the cash. Because for a lot of real estate folks, they maybe used to be a W-2, used to be a data analyst, right? You probably have big chunks sitting in retirement. You can't access that money unless you go the self-directed IRA route. But if you go the self-directed IRA route, you don't get any cost segregation deductions. You don't get depreciation. You don't get any of the other benefits of being a real estate professional. So converting that money into a version of a life insurance, infinite banking, and now being able to access that money and borrow from yourself often massively outweighs the cost to do conversions like that, right? Because there is a cost, and this is part of the reason why we always look at the pros and the cons for every strategy. So that's the first one I would consider. Now, the second one, and remember earlier I talked about if you hit that $1 million of gross sales, so not net profit, but gross sales. So if you flipped 2 or 3 homes at this point, 2 homes at $500,000 each, right? You've hit that $1 million of gross. There's another strategy. It's called an 831B. Sometimes it's also called captive insurance. Okay. Now, what I love about this program, same thing. You are basically creating a war chest. So you get a big deduction right now, typically 15% of your gross income, not your net, your gross income. So at $1 million, that's a $150,000 deduction. Because you have that $150,000 deduction, your taxable income is probably significantly lower at this point, okay? And that $150,000 goes into the war chest of the 831B, and in a year and a day, you can borrow back out against yourself, again, paying yourself the interest, up to 65% of whatever that balance is. So we have a lot of investors who will do the fix and flip side, and every year they're chunking away 15%, so that when they've built up a year, 2, they can now start borrowing against themselves, and literally they have their own bank. So those are the 2 big strategies that we're seeing used a ton right now.
Yeah, that's awesome. And I think I'm sure you got a few more gems. Like I know there are all kinds of crazy deductions in the tax credits, like $7,500 for renting an electric car. So I think that's probably one of the reasons why you're asking people about 500 questions on that survey to find out what they're qualifying for. But do you have any other favorite arcane chunks of tax code?
Oh, chunks of tax code. Okay, so we talked about the kid, we talked about the dog, and we talked about the master's exemption. Between those three, just so I'm clear, between those three, most people get an actual tax reduction of at least $10,000 a year. So we're talking chunks of money here, guys, right?
Yeah.
And, my next favorite one, let's see. I think it would be the accountable plan. So I'm gonna air quotes accountable plan. That's the term that you need to be asking your CPA. Okay. Now, an accountable plan is very specific. So if you have a business, S Corp, C Corp, partnership, even an LLC taxed as a sole proprietorship, or an LLC taxed as a Schedule E, okay, so your rental properties, you should have, there's two pieces to using the accountable plan deduction. The first piece is actually tracking your expenses, and I'll cover those here in a second. The second piece is having the actual plan, the actual document that says, this is what we're doing and this is how we're doing it. As a company, this is what we're allowing. Now, many CPAs will only track your expenses, but if the IRS were ever to come look and you don't have the actual plan document, all of the expenses will get taken away. And this is huge, right? We see this missed in about 90% of cases, 90. So it's huge. One of the worst cases we've ever seen, $190,000 a year that the CPA didn't have a plan for that the IRS took away. $190,000 a year, big numbers, okay? So what is this accountable plan? Okay, so many of us use our personal home, right, as a home office. We use our personal vehicle to go run errands, right, to go check out properties. We're using our personal cell phone to make calls, right? We're on that thing 80% of the time for business, okay? There might even be something, these are expenses that you paid personally that are really on behalf of the business, okay? Let's say you bought donuts, George, for everybody that's in your team, right? You brought donuts one day, but you used your personal card instead of your business card. Simple, you forgot to have the business card with you, whatever it is, okay? These kinds of expenses would go on the accountable plan. And the accountable plan itself, right? So home office, you know, one of the biggest things we hear people missing, a home office is a percentage of any penny that touches the house. So did you redo the landscape? Did you install a pool? Of course, new ACs, new roofing, new flooring, windows, maintenance, okay, cleaning, cleaning supplies, paper towel, vinegar, you know, like whatever it is, okay? A percentage of all of that belongs on your accountable plan. So for example, if you installed a pool this year at $50,000 and your home office is 10%, that's a $5,000 tax deduction, you know, that you need to have on your tax return, okay? So the accountable plan, the two pieces of it, track all the expenses, right? And the second piece, of course, make sure you have the actual plan document, because if you don't, the IRS has the right to take those deductions away.
Yeah, that's huge. I know there are a lot of people out there that are doing that deduction. Hopefully this show is going to help them to get that